Hello and welcome to Cost Accounting. I am your host, Dr. B, and today we're going to talk about job costing from a visual perspective. The first thing we'll do is we will look at the point of job costing, and we will include some terminology to help us organize individual jobs. First, it's important to understand what a job is. A job is a unit of production, which is the output, with unique costs assigned to it. The best way to think about a job is a specific customer order. A customer places an order with a manufacturing company for a product. For example, the customer places an order with Toyota to manufacture a new Corolla for the customer. That is a job for Toyota. It is the unique customer order. A job could be an individual item, a batch of similar items, or the provision of a service. It's important to cost jobs because without knowing the cost of the job, it is difficult to set the price to the customer. So price is oftentimes determined based on the cost of the job. This helps to ensure profitability and also helps to plan and control costs in the future. It also helps to predict cash flows in the future. It's important to understand what the cost of a product. As you recall, we have direct materials and direct labor and variable factory overhead that result in the total cost of a product. They're easily traced to the product or the service, and the overhead oftentimes includes indirect costs and are not easily traced to the finished product. Non-manufacturing costs are considered to be period costs, which includes sales and general administrative expenses, and these are found on the income statement as period costs. Manufacturing overhead includes things like depreciation of the factory, rent of the factory, property taxes on the factory, supervisor salaries, utilities to manufacture the product. And of course, other small items like hair nets, plastic gloves, etc., or supplies used by employees in the manufacturing process, like an adhesive, for example. You'll notice that utilities is what we consider to be a mixed cost. That is because there is a portion of a fixed cost plus the variable. The fixed cost is the cost of connecting to that utility as a connection fee. And then the variable cost is the variable wattage or usage of that utility. So a way to illustrate this is to look at the actual versus normal cost. The actual cost is what we actually paid. The normal cost is what it normally costs. The direct materials actual cost, direct labor actual cost, and the manufacturing overhead after we've applied the overhead rate in comparison to the normal cost of these things. The normal costs are what it would normally cost. It's the benchmark, if you will, or the budgeted amount. And we look at normal costs for direct materials, direct labor, and some factory overhead. The factory overhead oftentimes takes into consideration an estimated cost because of the fixed and variable cost components that are included in overhead. So we oftentimes look at timeliness of information in our ability to estimate normal costs. We make adjusting entries periodically to, of course, correct for any differences between the actual and variable costs. I'm sorry, the actual and normal costs. So how do we organize costs? We use what's called subledger accounts. As you recall, subledger accounts include things like the individual jobs within work in process. The individual jobs within the work in process, a job is recorded on what we call a subledger, and all of the related direct materials, direct labor, and overhead for that job is recorded on what we call the job ledger or job cost sheet. To find the related costs of these things like materials and labor, we use what we call source documents. Source documents, as you know, is the primary document that includes things like cost and quantity. In a direct relation to materials, we look at things like the bill of materials, which is the purchase of raw materials needed for the manufacturing process. We fill out what's called a materials requisition form in order to request materials in the production process from our storage. To record direct labor, we use time sheets or time tickets. And all of these things are recorded on what we call a job cost sheet. Job cost sheet details the amount of direct materials, quantities, and costs of those materials, the direct labor, which includes the hourly rate and the number of hours worked for each employee on that job, and of course, applied overhead used to complete the job. There are three basic sections of the job cost sheet. One, of course, is information about the job. Two is the costs recorded for that job, direct materials, direct labor, and factory overhead. The direct materials comes from the requisition sheet used for that include a listing of all direct materials and their related costs and quantities for that specific job. The direct labor includes the hourly rate and the amount of time worked on that job for each employee. This comes from what we call the labor timesheets. And then the third component of cost is the applied factory overhead, which oftentimes involves a single plant-wide rate method. Summary of the total costs are included at the end of the job cost sheet for each category. Second thing we want to talk about in today's lesson is how do we account for both actual and applied manufacturing overhead. The actual manufacturing overhead includes what has been incurred and how it's being tracked. It's the true amount of the overhead that's actually taken into consideration in the manufacturing of products within the factory. The actual manufacturing overhead does have some timing issues, though, because we don't actually know what the manufacturing overhead will be until after the jobs have been completed. The applied factory overhead takes an application to work in process inventory, and it's a result of daily, weekly, monthly calculations, and is an overall estimate that we apply to the process. With manufacturing overhead, we cannot count both actual and applied as product costs because it would be double counted if we were to do that. Manufacturing overhead control is an account that we use for both. We debit manufacturing overhead when it's actual and we credit when it's applied. To close these accounts out, we add them to a temporary account until they're reassigned. And this is a visualization of how that works. So you'll notice on the actual manufacturing overhead, we debit all of the individual manufacturing overhead accounts. When it's applied, we apply it as a credit. Balance it out and apply it to work in process. Here are the journal entries it would make for actual manufacturing overhead. We debit overhead control, and we credit accumulated depreciation for the factory or whatever the other accounts would be. Here we have another example to record supervisor salary, debit overhead control, and credit salaries, wages payable. This helps us to transfer those costs to work in process. Debit overhead control, credit raw materials inventory for direct materials, use of indirect materials. Or we have things like supplies, property taxes, repairs, maintenance. We debit overhead control, and we credit the accounts payable. There are two parts to, of course, applying manufacturing overhead. The first is to discover the budgeted overhead rate, and the second step is to multiply that by the actual usage of the cost driver. To find the budgeted overhead rate, we take the total budgeted manufacturing overhead for the year and divide by the budgeted usage of the cost driver. Example of this would be the number of machine hours or the number of employee hours throughout the year. Both of these inputs, of course, are estimated, so there's going to be some differences at the end of the year. The budget rate is also known as the predetermined manufacturing overhead rate. Actual overhead costs are incurred in prior years, so we adjust for what is known versus what is unknown in the upcoming year. Cost drivers are the allocation base on a cause of an effect relationship. You may recall this from your Principles of Accounting 2 course, or if you've taken other courses where we've discussed activity-based costing. This is what we're talking about when it comes to cost drivers. They're the activities that cause the cost to happen. That is a cost driver. Direct material costs are caused by the amount of the ingredients used. Direct labor is caused by the amount of labor used. So examples of cost drivers include number of factory hours, labor hours, number of machine hours, etc. Overhead costs are applied to the base, are based on the quantity of the driver used. So here are some common overhead hours applied: direct labor, number of hours worked, costs incurred, machine hours. These are very common cost drivers. Of course, the more we use at the factory, the more we incur overhead costs. This is the cause and effect relationship. So how do we budget for cost drivers? Oftentimes we look at prior years to understand what the current year might entail. So looking at trends, very important when budgeting for cost drivers. And these are common questions to ask. Will we incur more or less direct labor because we're expecting to make more or less units? Will there be more or less direct labor or machine hours? These are the common questions to ask when developing a budget for a cost driver. The second part of that equation that we looked at earlier is how much of the direct labor cost, how many hours of direct labor will we utilize, or how many machine hours will we utilize. And again, oftentimes this estimate is taken from the prior year. Here we have the journal entries that would make for applying factory overhead. We debit work in process inventory, and we credit overhead control. So why is it important that we budget for a specific job? Oftentimes we need to submit a bid to win a customer contract, or we need a lot of information about what the job will cost in the future before starting the job. So in looking at the calculation, we take the budgeted manufacturing overhead rate times the budgeted use of that cost driver. And so that gives us the budgeted manufacturing overhead rate. This is not different than the previous formula, but we use it for every job rather than for the entire company. That's the primary difference. So what are our terms that we just discussed? The actual overhead rate, which is what we actually incur based off of our manufacturing. Then we also have the applied overhead rate, which is an estimate, and it's not always going to be 100% accurate, and it's applied based off of the actual amount of the cost driver. The budgeted is also an estimate, and it's what we plan to do before we start the job. So let's take a look at this through an example. Here we have some employees where there's 1 full week to finish a roofing job. And so we look at the roofing job that we have ahead of us to figure out what the direct materials, direct labor, and factory overhead will look like for this job. So let's take a look at how to do this. So first thing we do is we look at what our estimated total manufacturing overhead might be. So the overhead budget for the year. In this example is 300,000. We expect to use 20,000 direct labor hours for the year. And so for this particular job, we're going to use 3 people, and each person will work about 38 hours to complete the job. So we figured that our direct material costs and direct labor costs for this particular job are going to be $6,790. The contract price for the customer is 60% markup on cost. So in knowing this information, we can calculate the manufacturing overhead rate for the job. So what we do is we look at the questions we need to answer. What is the final cost to be added to work in process? And what will the cost be? Since we already know a lot of the information for direct materials, direct labor for that particular job, we can figure out the factory overhead from there. And knowing that the total factory overhead is 300,000 for the year, and we know that there's 20,000 of hours of direct labor for the year, and that there's 3 employees working 38 hours each on this job, we can figure out the overhead. And so the way we do that is we take the 300,000 total budgeted overhead divided by the 20,000 labor hours. That's $15 per direct labor hour. There's 38 hours for 3 people. That's 114 hours total for the job, times the $15 per hour. That gives us a budgeted manufacturing overhead rate of $1,710 for this job. We then apply that $1,710 for that job to work in process inventory for the job, giving us a total job cost of $8,500. Now remember, we add in 60% to this total for our markup for our target profit. And so the way we do that is we take the 8,500 and multiply it by 1.6, which gets us to $13,600 is the amount that we would charge the customer. So for those of you who would want to analyze that further, you could also find your gross profit for this job. So here we have another objective for this lesson is to follow the cost flows through T accounts to calculate job costing. So with any job, we of course start with direct materials, then we apply direct labor to work in process, and ultimately we apply factory overhead to end with the total cost of manufacturing for that job. In this example, it looks like we are producing French fries, maybe, based off of the ingredients that we're looking at here. So here's how it works. And following the flow of the costs, we start with raw materials inventory, where we're purchasing our raw materials for the manufacturing process. We move those raw materials into work in process as we are using them to create our product. We incur direct labor in the work in process step. We also incur indirect labor and other actual manufacturing overhead. And then we apply our overhead costs to our work in process. Once the work in process step is completed, we transfer that to finished goods inventory. And then ultimately, when we sell our finished goods, it moves off of our balance sheet and onto our income statement as cost of goods sold. So if the first step, of course, is to buy raw materials. That's how we begin to produce any type of product. So we purchase our raw materials, which of course get added onto our balance sheet. And our costs include things like the invoice cost plus any type of shipping, any type of taxes, or if there's import taxes, etc. So here we have an example. We are purchasing potatoes, 1 unit. We can make 10 patties from. So here we have the example. We are purchasing potatoes, and so that's our raw materials. So we debit raw materials inventory, $800 worth of potatoes that and then we have which includes $650 worth of direct materials and $150 of indirect. And then we credit accounts payable, $800. Looking at the T account, our purchases are $800, leaving us an ending balance for raw materials inventory of $800. Now we begin the process of turning those raw potatoes into our product. So of course we're going to transfer our direct materials into work in process. We're going to add in direct labor and some applied overhead. In order to move those potatoes into work in process, we fill out what's called a materials requisition sheet for that job. And so this is what a materials requisition sheet looks like. You'll notice that we have the individual raw materials listed out here based off of the part number, description, the quantity, the cost per unit, and the total cost. Of course, we find total cost by multiplying the unit cost times quantity. We add those all up to get the direct materials total. Then, of course, we also have some indirect materials such as hairnets and plastic gloves. So quantity times unit cost to get the total indirect materials. Once the requisition sheet's been completed, we send that to the warehouse where our raw materials are, and then the inventory gets transferred into work in process. And so the journal entry that we make for that transfer is we debit work in process inventory for that job, and we credit raw materials inventory. To add in our overhead, we debit overhead control and we credit raw materials inventory. So our work in process inventory is the total of the direct materials used plus the overhead. For direct labor, we have an understanding of how long each employee will be working on each job. We look at things like their wages, the unemployment tax, insurance contributions, and other paid benefits to get the full burden labor rate. So here we have our employees that are working on this particular job. In order to allocate their wages to that job, we debit work in process inventory for the job and we credit wages payable. So of course that increases our work in process inventory balance. To find our applied overhead, we pool the total costs together. And we debit overhead control and we credit the various accounts that we're incurring. To scatter the overhead costs to the job, we debit work in process inventory and we credit the overhead control account. So looking at our example, we have the following information for the overhead. Before we estimated that our overhead will for this product will be $2,460. Our cost driver is direct labor hours, and we plan to use 820 labor hours for this product. So we take the 2,460 divided by the 820 direct labor hours to get an overhead rate of $3 per hour of direct labor overhead. And so we take that amount and we apply that to our individual drivers. So that gives us, of course, a difference in looking at the actual versus the applied. The actual came in at 230. The applied was $204.75. It gives us a difference of $25.25. Which means we underapplied overhead by that amount. And so in that case, we, of course, make an adjusting entry. We debit work in process inventory and we credit the overhead control. To apply the difference, we debit overhead control and credit accumulated depreciation and overhead control to raw materials inventory. And what that does is it helps us to balance out the difference. And we debit overhead control, and then of course we credit cash to pay out for our overhead. So we add our overhead to the work in process inventory. And of course, finally, we move our product when it's done out of work in process inventory into finished goods inventory. There's no additional cost added at that stage. And of course, it becomes finished good cost of goods sold when we sell the finished goods. In our example, we did not have any finished goods inventory at the beginning of the period. We have a total cost of $1,200 that were finished, so we move that to our finished goods inventory, and we end up selling $600 worth of our product, which had a cost of $400. So we debit finished goods inventory, $1,200, and we credit work in process to transfer out of work in process into finished goods. We sold some of those finished goods. So we sold cost of goods sold $400, cost of goods sold $400, and credit finished goods inventory $400. The sales price was $600. So we debit accounts receivable $600 and we credit sales $600. . And of course, as you can see through the T account process, the transfer from work in process to finished goods. Of course, we utilize generally accepted accounting principles when it comes to the regulation side of things, which is, of course, as you know, our income statement, balance sheet, statement of cash flow, statement of retained earnings. And so in that, we have to follow the recognition principle, especially as we're making sales and incurring costs. When we sell our products, of course, we're moving uh, from our finished goods inventory onto our on our balance sheet, off of the balance sheet and onto the income statement as cost of goods sold. That's why it's important to understand the physical flow of how things work. So you might be asking, what about selling and administrative expenses, and what about the related expenses and other parts of overhead? So for selling and administrative expenses, these are period expenses that are found on our income statement. When it comes to the overhead components, we include our overhead components in work in process, which ultimately make it their ways to finished goods inventory and then ultimately to cost of goods sold. So things like rent expense, because we include rent expense in our overhead estimation, that's why you won't see rent expense on the income statement. So what are the impacts when it comes to job costing on things like salaries and wages? So these are, as we mentioned, typically we identify those as being period expenses. And then if they are period expenses, they end up on the income statement. If they are part of overhead, they find their way onto work in process inventory, and then finished goods, and then cost of goods sold. So salaries and wages for direct employees and indirect employees, you won't see salaries and wages expenses on the income statement because they're part of the manufacturing process and their wages are included in overhead. So what's the impact on the balance sheet? Of course, our assets, direct materials, raw materials, work in process, and finished goods inventories. So those are all asset accounts. So of course, those are heavily impacted. There's depreciation associated with the factory and the machinery, etc. And so because the factory and the machinery are a part of the manufacturing process, we find those to be in overhead, and so therefore you won't see depreciation expense on the income statement. At the end of each year, we close out our temporary accounts, which would include things like our overhead control account. And we need to zero that out at the end of each month or end of each year, based off of the process, right? Because it's a temporary account. You'll never see manufacturing overhead control on a financial statement. It's a temporary account. Yeah. Oftentimes you might see that in a budget, but you won't see it in the financial statement. So what happens to the temporary account, or what happens when there's an imbalance, what under applied or over applied overhead? Well, of course, we make adjusting entries where necessary. Those adjusting entries are important to allocate or to write off those imbalances. And so here we have an example of this. So when it's over applied, we debit overhead control and we credit cost of goods sold. If it's under applied, we debit cost of goods sold and credit overhead control. Debit overhead control, credit work in process, inventory, finished goods inventory, and cost of goods sold. When there's an over application, when there's under application, it's the opposite. So we debit work in process, debit finished goods inventory, debit cost of goods sold, and credit overhead control. The impact on the income statement, of course, are your period costs, but we also have our finished goods inventory, which becomes cost of goods sold when it's sold. And that is the impact on the income statement. How do we calculate the cost of goods manufactured? We take direct materials used plus direct labor plus applied manufacturing overhead plus beginning work in process inventory balance minus ending work in process inventory balance to find the cost of goods manufactured. And of course, to find cost of goods sold, we take beginning finished goods inventory plus cost of goods manufactured equals cost of goods available for sale minus ending finished goods inventory equals the cost of goods sold. It's important to know these formulas, especially when it comes to budgeting. So what about the decision-making process when it comes to job costing? What are the considerations? Well, first, of course, is pricing. It's very critical to understand the job costs before you're able to set a price for your products. So what are the approaches for pricing? The cost plus approach, which is the cost of the product plus the planned markup. Target costing, which includes we set the price and then we add in the cost to achieve a goal. Or we can match what our competitors are doing. There's a lot of possibilities when it comes to pricing. It's important to set the right price to, of course, achieve profitability. A job that's not profitable oftentimes is because you didn't set the price correctly, or there was an overrun on costs, or something unexpected happened. So that would cause a job not to be as profitable as expected. So once we've identified our target profit or a set price, we can achieve our desired profitability by modifying our prices and controlling our controllable costs. As the prices change, of course, we need to reevaluate the product mix, and we also may need to focus on other jobs with higher margins. External factors, of course, include things like environment, sustainability, social justice issues, and we take these into consideration when making decisions about the manufacturing of our products. This could include things like the use of plastics and other environmental conscious issues in the manufacturing process. Ethical issues might include things like the budgeting to performance evaluation, employees being motivated for the wrong reasons, or other ethical issues might evolve around the misrepresentation of costs on certain jobs, like inflating costs or omitting certain costs, or misstating the percentage of completion of a job. Those are all ethical concerns. Overcharging for a job, whether it's intentional or by mistake, oftentimes leads to recording a lot of costs in a job, whether costs should be capitalized or expensed out is another concern. Undercharging a job oftentimes is a result of not truly understanding the total costs, omitting certain costs, or not properly recording costs as they're being incurred. Misrepresenting the completion of a job often correlates with understating a percentage of completion, or saying that something's 75% complete when it's only 50% complete. This often goes back to not properly recording your costs at each stage of raw materials, work in process, and finished goods. So how how does job costing work for service companies? For service companies, the revenue is based off of the services being provided to the clients. And so the job costs are oftentimes related to that specific client. For example, an attorney will track things like service fees, filing fees, photocopying, hours worked, etc. Those are the direct costs related to that client. And so the invoice is tracked accordingly. Employee time, like an attorney, the billable hours are the work performed for each client is billed accordingly based off the employee's time. So what did we learn in this chapter? We learned how to summarize the job costing. We looked at all the different terminologies. We looked at how to organize the jobs. We understand how to account for actual and applied overhead. We looked at the cost flows through T accounts. We learned how to calculate the cost for the jobs and products. And we also identified the relationships and ethical considerations. And the last thing we did is we looked at how to do it for service companies. Thank you all so much for your time today. I hope you appreciated today's discussion on job costing. If you have comments, questions, or concerns, please email me, call me, set up office hours. I am here for your support. Thank you very much for your time today. Have a great day.